Welcome to the deep dive. Today we're wading into some really tricky waters. We're talking about the surplus funds recovery industry that's, the leftover money after a property foreclosure or tax sale, and the harsh reality. This area is, well, it's rife with predatory schemes, people getting taken advantage of when they're already down.
It really is a huge issue of vulnerability. I mean, think about it. Someone loses their home. They're often under immense stress.
Yeah, just completely overwhelmed.
Exactly. Anxiety, exhaustion.
Yeah.
It just makes them incredibly susceptible to fraud. Which brings us to our focus today, something different. An approach called LOANSMART AI. It's billed as an AI-driven ethical equity recovery strategy.
Okay, ethical and AI-driven. Let's talk about the hook, though, because they seem to be setting themselves apart right away. The standard fee in this industry, it's often like 25%, sometimes up to 40%.
Oh, easily. Sometimes even more, quite frankly.
Okay.
But LOANSMART AI, they're committing to a fixed 10% success fee.
Wow, okay, 10%. That's a huge difference.
It's massive. Let's put some numbers on that. Say there's $50,000 recovered. A typical agent taking 30% means the client gets $35,000.
Right.
With this 10% model, the client keeps $45,000. That's an extra $10,000 directly back to the former homeowner.
Okay, but that low fee, it almost sounds a little too good to be true, especially in an industry known for scams. How do they counter that suspicion? You've got these predatory types demanding huge percentages, sometimes upfront cash.
Right, and that's a key part of their strategy. They actively reframe the whole interaction. It's not about debt recovery in the cold sense. They position themselves as a trusted financial resolution partner.
Okay, so building trust is paramount.
Absolutely. Their credibility seems built on the founder's background, David Hoffman, apparently in the mortgage game since '98. And they even have published resources like a credit score guide. They're trying to stand apart from those unlicensed folks charging crazy fees or just disappearing.
So the antidote to the scams is transparency, experience, ethics, and this tech anchor, plus a genuine contingency setup.
Exactly. It's what they call a risk reversal model. And really, if you think about it, that 10% fee only makes sense financially if you can process claims super efficiently and accurately. That's where the AI really comes into play. The whole point is maximizing the net recovery for the client.
Okay, let's dig into the AI then. They say it's not just filing forms, it's a forensic audit. So what is this LOANSMART AI actually doing when it sifts through all that data?
So imagine a really, really fast forensic accountant. When a property's foreclosed, the trustee often adds various deductions, legal fees, admin costs, you name it. The AI scans every single line item.
Looking for what exactly?
Anomalies, specifically improper deductions. It flags things like excessive fees, maybe unauthorized costs that were sort of slipped in there quietly.
Okay, that makes sense. But I read it also looks for hidden value.
That's right. That's maybe the most interesting part. It hunts for money the client might not even know there's maybe misapplied escrow funds or insurance payouts that got lost in the shuffle during the foreclosure chaos.
Ah, okay. So it's not just about cutting bad costs, but finding overlooked money, too.
Precisely. That's how they argue they maximize the actual amount the client gets back, making their net return significantly higher, even with the fee.
And the speed factor is huge here, isn't it? There are deadlines.
Absolutely critical.
Yeah.
These statutory deadlines can be surprisingly short. Texas, for example, gives you just 2 years from the sale date to file your claim. A human auditor. Well, they just can't sift through that volume of data, especially across different states, fast enough.
Got it. So let's just clarify that risk model again for everyone listening. For a decent-sized claim, say over $25,000, it's pure contingency. No upfront costs related to the profit.
Correct. No upfront profit-based cost on those larger claims. Now, for smaller claims, they do have a small retainer, like $100 or $300.
Yeah.
But, and this is important, that retainer is strictly for covering essential admin stuff, like getting certified court documents.
Yeah.
And crucially, it gets fully credited back against the final 10% success fee. So you're not paying twice.
Right. Makes sense. So the big takeaway here for you, the listener, it seems to be about leveraging tech for speed and accuracy, pairing it with a really low fee and, importantly, an empathetic approach to help vulnerable people get the maximum funds back.
Yeah, and beyond just the strategy, there's a real legal clock ticking. These surplus funds don't just sit there forever. If nobody claims them within the legal time frame,
They disappear.
they often escheat, which is a legal term meaning they revert to the state treasury or some other designated party. Gone for good.
So prompt action with specialized help isn't just advisable, it's essential to get what's rightfully yours before it vanishes into state coffers. It really makes you think, doesn't it? How technology can bring, accountability and clear-eyed transparency into these really complex, often emotionally charged financial situations.